Hey everyone, how's it going? So today I thought we would look at rolling a cash secured put. What oftentimes will happen is you will sell a cash secured put, the stock will drop, and your strike price will get tested. And a lot of people ask, should I roll this? What should I do? And some people will wait till it gets deep in the money. I guess the short answer here should be that if the stock drops and your strike price is getting tested, that's going to be the optimal time to roll. At that point, once it starts getting deeper in the money, it's going to be harder to roll for a credit. You're still going to be able to get a credit, but it's going to get harder and harder the deeper in the money it gets. So what we're looking at here is basically what I've done is I've compared the at the money strike, which is going to be in orange. We have the in the money, roughly 8% in the money, which is going to be in gray. And then we have 16% in the money, which is going to be yellow. And these first 5 groups of columns here are all just adding 14 days of duration into the trade. So we can see at the far left here, we have 4 days to expiration. We're going to roll it out to 18 days to expiration. So we're adding 14 days here. The second column, we're at 11 days, we're going to roll it out to 25. The third column, we're at 18 days, we're rolling out to 32, and then 25 to 38, and 32 to 46. And then the percentage is basically going to be the percentage from the front month to the back month. So if the front month is 11 days to expiration and we're rolling to 25 days, so that would be the back month. So basically, let's say that the front month 11-day to expiration was $50 at the money, and the 25-day to expiration is $100. A gain from $50 to $100 would be roughly 100%. I've also tested some longer duration stuff. We'll look at that in a minute. So basically what we can see is that the closer to expiration we get, the basically larger credit that we can get depending on how deep in the money it is. Once we're 16% in the money here, this yellow line, we're not really getting anything. It's pretty negligible here. Another thing to think about is once you get far deep in the money, the spread between the bid and the ask gets kind of large. So, that could take up easily 0.5% of what we see here for these yellow columns. So once it's in the money, it's not really going to make much of a difference rolling these time frames anyway. It will make somewhat of a difference though if you're only say 8% in the money. We can see that if we're 8% in the money and with 4 days to go to expiration, we can roll this out 14 days and roughly collect another 16% of premium. But the same contract, say at 25 days, if we roll that out 2 weeks, which is the same time frame, but we're farther away from expiration, we're going to get 8%. So we can see that if our strike is close to at the money and we think it's an overreaction, it may actually be better to hold it and see if it rebounds quickly. But that's something you'll have to decide. Do you think this is an overreaction, or do you think that the stock is going to continue to drop? And then we can see that at the money basically gives us the most return for rolling. And pretty much in all of these instances right here, at the money strike, if we roll out 2 weeks on any of these, we can actually roll out and down at least one strike on every one of these here. We can go out, down, and down at least 1 to 2 strikes. And the reason for that is because since we are closer to expiration, we're dealing a lot with weeklies here. I think one of these expirations was a monthly expiration, but for the most part, they were all weeklies. And because they are weeklies, on this particular stock, I think it was like a $50 stock, 55 something in there. We had basically $1 wide strike prices for 4 of these 5 weeks. I can't remember if it was the 32 or the 38. One of these weeks was a monthly expiration, so we only had $5 wide strike widths, but the rest of them we had $1 wide. So, we could always at least roll out and down $1 to $2 every one of these. Especially all of the at the money ones. But once we get into farther out in duration, we start dealing with monthlies, and pretty much the 18 to 46 days for expiration. We're getting roughly 28 days here. This is actually the last time we were able to roll out and down at the money strike, because this was the last weekly expiration. We were rolling from 18 to 46, and at 46 days, we still had $1 wide option contracts. Once we went to 67, we were at $5 wide contracts, so we had to roll to the same strike. Another thing to note is that this 67 to 95 here, it looks like we actually jumped up here even though we had less days. The 32 to 67, we increased our trade time by 35 days. The 67 to 95, we increased it by 28 days. The reason that these numbers are higher or equal to this roll right here is because this is actually an expiration month that has an earnings announcement. So the premium in this month was actually elevated a little bit. I want to say for the 67-day strikes, the implied volatility here was around 50%. The IV here was actually closer to 60%. So that small jump implied volatility for these contracts was able to boost these contracts up a little bit to give us a little bit more premium. So that is why this is like this. Otherwise, these would keep trending down like what we see here. And then once we go from rolling from 95 to 150 days, we're actually adding 55 days on here. And we can see that at the money, we're only getting about 18.5%. The 8% in the money is roughly 11%, and then the 16% in the money is roughly 7%. And now if we want to compare them all, we can see how basically these are the short duration right here, and these are the longer duration right here. And we can see that rolling from 18 to 32 days, we're adding 14 days on. It actually does somewhat compare to the 18 to 46 days. We're getting 28 days right here, so we're getting double the time, double the duration, but we are not quite double the return on premium. But the at the money, we're getting 40% there, we're getting 62 there, so that's not quite double there. One thing to note, the farther out in time we get, being in the money, say 16%, these closer to expiration trades, being 16% in the money is going to give us a pretty high delta, close to say an 80 or a 90 delta. Once we get farther out in the money, this 16% in the money here, it's say 95 to 150 days, it could only be maybe a 70 delta. So that is why we are able to get more credit out here for this in the money option. If we want to compare delta to delta, then pretty much it stays real close to this 2 to 3% range. I did check that in another test here, and it's very comparable. So anyway, hopefully this was helpful. Maybe you learned something. Thanks for watching, and have a great day. Bye.